Hi everyone and welcome. Today we are providing an update on our Alabama portfolio currently on the contract, specifically focusing on what has taken place since our on-site walkthrough. As always, introducing ourselves, my name is Vinny Carriers and I am here with my partners Tim and Matthias. Tim is on the road today, but he is completely committed to making sure you guys get the latest updates. So that's why he's on the call. Say hi guys.
Hey everyone. Hi.
All right, so quick reminder, right? So Matthias and I were recently on the ground in Alabama walking the 5 parks. We came away with a very strong level of conviction in the deal. Everything is looking really positive. So since then, the team has continued working through the due diligence, confirming key assumptions, and making progress towards the closing. So on today's webinar, we'll cover what's been confirmed since the walkthrough, some updates on due diligence timelines, and any changes in underwriting, the business plan, how everything's changing as we move along. And lastly, and how can investors participate in the deal, because now our fund is open and accredited investors are able to participate on this particular fund/deal, and we can touch on that. But before we begin, let's briefly recap the opportunity, right? So it's a 283 lot park, 5 park portfolio outside of the Birmingham, Alabama market. And all parks are within 30 minutes of one another. Rents are significantly under market, and the business plan would be to infill, bring expenses down, and bring rents up to market. So with that said, let's get to it, right? So something that's really big is financials and making sure that financials are matching what we're seeing through the due diligence, right? Checks and balances. Matthias is the walkthrough. We have continued looking at the financial and we have dug a little deeper at the numbers. Can you talk about the outcome of the financials review up to this point?
Absolutely. Thanks, Vinny. So that process is pretty involved. So we have somebody on our team as one of our partners. He has his own accounting firm, so he's a master at this. So what he does, he pulls all the bank statements together and looks at all the transactions that happened over the last 12 months for all 5 parks. And then basically he reconciles everything into a spreadsheet and audits every single line item and compares that to the P&L that we received before we got on the contract, when we underwrote the deal the first time, and also compares it to like what we have in our underwriting in general, where we can bring this to from our business plan, right? And see if we are off on the income side, if we're off on the expense side, what's the delinquency. So make sure our assumptions are not too aggressive or maybe even too conservative in some sense. Putting everything together, I literally had the final call with our partner before this webinar here, so I'm happy to report the entire financials, if you look at the entire set, is only off by like about $5,000, which is immaterial. It's really nothing considering this portfolio makes over $1.3 million of income and the NOI is at 861, so it's actually $5,000 on the good side, so it actually makes more on the NOI side than expected. And the difference is probably from timing, because when we received the P&L compared to when you look now at the T12, when we underwrote this first was late last year, probably they made some improvements in the meantime and actually performs better than when we got on the contract initially. So this is a huge green light that we're getting, because that can kill you really fast. We had deals before we backed out of because the income wasn't even close what we anticipated it to be. So I'm really happy about that. It actually makes more income than expected on the total income side. So this is always a good defense mechanism as well, having good cash flow right out of the gates. So this is all confirmed now. And with that, we kind of looked at also the delinquency side, and which is also extremely low. And that can only complement the seller, that they have really, really low delinquency. And you look at the rent roll and what actually they're receiving, they're running between like a 1.3, 1.5% delinquency. And the portfolio of the size is pretty respectable. So really happy with those numbers.
So as you guys can see, that's a big deal, right? The financials piece. A lot of deals in the past where they have died, numbers don't add up, and at that point it becomes a highly risky situation, which we are not willing to entertain, right? Because we want to protect investors' money at all costs. So hey, everything's looking good so far. One update we want to address is the due diligence timeline. So we have made a decision to extend due diligence by 15 days. Tim, can you touch on the decision on extending the DD timeline?
Yeah, we are performing thorough due diligence, of course, and doing some checks on all the septic systems, and we haven't been able to get anyone to come and do that until like this week. And technically, due diligence ends on Monday, and sure, they'll get it done before then. But we also want time to review, make sure that we're not getting into anything that is going to be an issue. So yeah, we put up more money to extend due diligence to make sure that we're not rushing. We don't rush. We do things methodically. We do things so by the time due diligence ends, we are 100% in a deal. There's no question marks for us after that.
Absolutely. We're doing our due diligence, and we'd rather extend the timeline to make sure that everything adds up to what we are seeing, and making sure that the parks are good before we proceed to close. Okay, let's transition into the business plan, right? So before the walkthrough, we have certain assumptions, right, based on the data that we're provided. But Matthias, when we walked the properties, a lot of homes were move-in ready, and we were not anticipating that. So obviously that changes the business plan, right? On the positive side, can you talk about things that have changed in the underwriting / business plan since the walkthrough?
Absolutely. So the biggest difference is we reduced the capex amount needed for the vacant homes. So in the beginning, we always assumed like a doomsday scenario, meaning we have to spend a lot of money on all of these homes. About $10,000 a home was the initial assumption that we have to spend on all the 41 vacant homes. And we reduced that down to $7,500 because there's still homes out there that need some work, and some need more than $7,500, but there's many that need less than 3 or than 2, and some are ready. So we keep the average somewhat higher still, just in case. And once you start renovations, and anybody that did any renovation in the past before, we always know it's more expensive once you get started because you always discover things. So, but it's still a pretty significant reduction on capex for the homes. So, and also on the other side, like I mentioned before, the delinquency, we had a year one delinquency of 10% anticipated, just because you take sometimes properties over, and we had one, we had last year, we learned, okay, maybe we should go in with a high delinquency amount because, the previous owner was not placing good tenants. And then we have to do a lot of evictions, and we have some vacancy there. So the year one, we try to be conservative and have a higher delinquency amount as well to kind of compensate for that. But looking at all these numbers right now, and also seeing the income on the income side and the stability of the rent roll, we can significantly reduce that delinquency assumption. So we went from 10% to 5% in year one, and this is still like 3.5% higher than what they actually are. So it still leaves some buffer in case we have to evict people, because we have different operators have different philosophies of leasing. The good ones always use somewhat the same guidelines and screening criteria, but there's always exceptions that are made sometimes, and especially trying to keep the property occupied during sale. And there might be some influx of bad tenants. Not saying that's happening here, but it could always happen. We have seen it in the past. So we want to just safeguard us from that, obviously. And then in the following years, we go from 5% to 3% delinquency, because on a portfolio of this size, 3% is still a significant amount of money we would lose in bad debt. Again, if we operate in a similar level as the current owner right now, they are around 1.3 to 1.5% right now. It still gives us a good safeguard, but also it makes the business plan work even better, and the returns look much better because there's much less money lost. So the capital raise amount is a good bit lower because of this, because we reduced the home capex amount. And also the business plan itself, from an infill perspective and turning vacant homes over, we kind of kept it the same because it was always conservative in the first place. So back to Tim's point, we don't like to rush things. We always take action swiftly, but we don't want to rush. We don't want to go into a deal and then immediately have our back against the wall and have to infill homes tomorrow and turn vacant homes over in like days. That just causes more accidents and mistakes, and those are costly. So we want to be very steady and have very steady progress by steady action. So we kept the same infill and capex for the home turnover, pretty much the same. So those are the major changes that we did. There's nothing else that needed to be changed, which is a good sign as well. There wasn't many discoveries that we made that needed a complete overhaul of the financials and the underwriting. So I'm pretty happy with that.
Yeah, absolutely. Everything's looking positive. And another important update, our fund, WCG Growth Fund, is now officially open and live for accredited investors. So for those evaluating the opportunity, let's walk through projected returns. So we are targeting 16 to 20% IRR, 2.4 to 2.8x equity multiple. The hold period is 7 years. And we are providing a 7% preferred return for investments between $50,000 and $250,000, and a 9% preferred return for investments above $250,000. Another important component here is tax strategy. So across the full fund, we're targeting approximately $1.50 plus in year one depreciation for every $1 invested. So this is driven by cost segregation and accelerated depreciation strategies. With that said, taking everything into account from the walkthrough to the confirmed financials and continued due diligence, Tim, how are you feeling about the deal today?
I like the deal. I mean, it's one of those things that the deal just keeps getting better and better. And, of course, it fits into our overall strategy, buying recession-resistant mobile home parks, providing affordable housing to people. And, this fits in our overall goal. We love mobile home parks in the Southeast. We love that we can put some money into them and make them nicer and provide those nice, safe communities to people at a super, super reasonable price. So it's one of those things that, why I love doing this is because we can create wins for everyone. Our investors make money, we make money, our tenants get great places to live. It's, that win-win-win scenario. So I'm excited, man.
Absolutely. It's great. Matthias, any closing remarks from you?
Not really on my side. I mean, we went through the financials already. That was really in depth, but there was no major discoveries. I always love the cash flow of this deal. We're buying this at a 10.5 cap, which is unheard of these days. As a matter of fact, all three of us had a call this morning with somebody that buys a lot of mobile home parks in Alabama, and they also loved our purchase price and our entry in this deal, which that means a lot as well. So just continue to be more and more excited about this deal, and I can't wait to get this under wraps, get it closed, and get it to operate at the highest level.
It feels great, right? You get the butterflies in your belly that everything's matching up, adding up, and we're getting ready to close. It's really exciting. So to wrap things up, since the walkthrough, we have confirmed the financials and validated our underwriting, continued digging into due diligence with disciplined approach. We extended our timeline to further de-risk the deal, which is our main priority when we do these due diligence processes. And we tweaked the business plan based on what we saw on the walkthrough, and everything is still looking really positive. At the same time, our fund is now live and available for accredited investors. So if you have any general questions about the opportunity or what we do, how we do things, or specific questions about the deal we are presenting, we encourage you to reach out to us directly. We're happy to walk through everything with you. When you schedule a call, you'll get Tim, Matthias, and myself, so you won't get somebody else. We'll talk directly to you so we can address your questions. So with that said, we appreciate you taking the time to watch this update, and we look forward to keeping you informed as we move forward. And our contact info will be right below, so make sure to reach out. Again, we are here to help, we are here to educate, and we are here to answer any questions you may have about this particular deal. So with that said, until next time, and we hope you have a great one. Take care.
See you guys. Take care.
Thank you guys so much.